Hello, welcome to our video presentation about personal balance sheet. This is brought to you by Brown Collar Channel. Don't forget to subscribe and hit the notification bell so that you will be updated on all videos related to personal finance. What is a balance sheet or statement of assets, liabilities, and net worth? The term balance sheet refers to a financial statement that reports a person's or company's assets, liabilities, and equity at a specific point in time. It lists all your properties and financial obligations. Why do you need to have a personal balance sheet? A balance sheet gives you a snapshot of your financial position at a given point in time. It is a tool to help you in your financial planning and in making financial decisions. For examples, you want to buy a car, you will ask yourself, how much cash do I have for down payment? Can I buy a second-hand car in cash? How much is the value of all my investments? The balance sheet will give a bird's eye view of your finances and help you to plan accordingly. The first part of balance sheet is the assets. Asset is a property owned by a person or company that has a financial value. Assets can be classified into two categories, current and non-current. Current assets are short-term, highly liquid, and easily disposable. Examples of current asset are cash and cash equivalents, accounts receivable, marketable securities, and retirement fund. Cash and cash equivalents includes monies in the form of banknotes and coins, bank deposits, our savings and checking accounts, and time deposits up to 3 months is considered cash equivalent. Accounts receivables are amounts that other people owe to you and you expect to receive in the near term. If the repayment covers multiple years, it can be classified as non-current asset. Notes receivables, and only the portion that will be received within 1 year is classified as current asset. Marketable securities consist of our paper investments such as stocks, bonds, cryptocurrency like Bitcoin and Ethereum, and time deposits more than 3 months is considered long-term investment. Retirement funds. These are the 401ks, annuity funds, current pension, and cash value of life insurance. CVLI is applicable to variable life insurance that has an investment portion. Let's now go to the next asset category, which is non-current assets. Non-current assets are long-term, fixed assets, and normally has a useful life of multiple years. Here are the common types of non-current assets. First in the list is real estate properties. If you have a residential home, or investment rental properties, or commercial buildings, it will fall in this type. Next are the transportation assets, automobiles, boats, plane, bus, etc. The third is jewelries made up of gold and other precious metals and stones. And it also includes special collections like magazines, toys, antiques. Last example is home furniture and art decors. The list that is presented here is not exhaustive of all types of personal assets that you can include in your balance sheet. You might have other assets that is not discussed here, but you may classify them based on what have been discussed. Let us now go to the second part of the accounting equation. The liabilities. A liability is something a person or company owes, usually a sum of money. What do you think are the common types of personal debts? Do you have a financial debt right now? Let's discuss briefly those personal liabilities. Credit cards. This is the most common type of personal liability. Most people use credit cards for their personal expense. Other short-term debts from our family members, friends, or other people when they let you borrow money from them for different purposes. And then we have the mortgage loans on our houses. It is usually 10 to 20 years of amortization. Last sample for personal liability are bank loans like auto loans, personal loans, and salary loans. We have different purposes in availing loans from banks, cooperatives, credit unions, and other financial institutions, and most of it is to acquire assets. And lastly, we can now determine how much is our net worth. The value of the assets minus total liabilities equals net worth. Yes, creditors have a priority share on your assets. That is why liability comes first in the equation before the net worth. Now, what happens when liability is greater than your assets? Meaning you have a negative net worth. It is called a state of insolvency. Insolvency is a state of economic distress where the debtor cannot fulfill its financial obligations. In simple terms, it cannot pay its creditors for a specific set of time. It can lead to bankruptcy. Bankruptcy is a court order that decides how an insolvent debtor will deal with unpaid obligations. That usually involves selling assets to pay the creditors and erasing debts that can't be paid. Good financial planning through the use of financial statements such as the balance sheet is a good step to manage our finances responsibly and avoid financial distress. To summarize, balance sheet refers to a financial statement that reports a person's or company's assets, liabilities, and equity at a specific point in time. Asset is a property owned by a person or company that has a financial value. A liability is something a person or company owes, usually a sum of money. Net worth is the value of the assets a person or corporation owns, minus the liabilities they owe. Insolvency is a state of economic distress where the debtor cannot fulfill its financial obligations, which can lead to bankruptcy. In our next video, we will create a personal balance sheet that can be easily viewed on your personal phones, and we will discuss how to analyze your personal balance sheet through the use of different ratios, that is, utilized in financial management of businesses. We will also share with our subscribers a free copy of the personal balance sheet. Don't forget to like, comment, and subscribe to our channel so that you will be notified of future videos about personal finance. Thank you.